chair now recognizes himself for 5 minutes for questioning. And at the outset, let me offer, without objection to the record, a statement from the Financial Services Forum for the record. Without objection, that document will be submitted for the record. Let me start with Mr. Barr. I'm very concerned about the impact on mid-size and regional banks with the Basel III Endgame as proposed. Vice Chair Barr's de facto repeal of the bipartisan S-2155 undoes tailoring, conforming capital requirements for all banks above $100 billion, which will result in a barbell banking system. We'll have some community banks that are exempted from this proposal. We'll have too big to fail Wall Street banks, but the regional banking sector is really in the crosshairs here. And this will result, as I said, a barbell banking system, and it will eradicate the diversity that makes the U.S. banking system the envy of the world. Mr. Barr, please comment on the proposal's impact on the regional banking sector.
Sure, thank you. First, I would just note, regional banks now are actually well capitalized. Their challenge currently is actually an earnings challenge, especially at a time when deposit costs are rising and loan rates are not. And of course, this would add a massive cost to them. If you think about the proposal, under the Basel agreement, they were supposed to benefit on credit because more granular risk weights would lower their credit charges. But here, the U.S. regulators have done add-ons, which they like to call gold plating to those. Regional banks will also see large operational risk charges. So they definitely come out net losers under this. And then more broadly on tailoring, even away from credit risk, they're subjected to a whole panoply of regulations that are not really fit for them. That includes detailed reporting on market risk, and they don't take a lot of market risk, resolution planning. Again, things where it's not the supplementary leverage ratio. Again, things that aren't really important substantively, but also come with a massive compliance burden. And of course, that's one reason Congress enacted 2155.
Thank you very much. And Mr. Ullman, I was very impressed with your testimony relating to the Administrative Procedures Act. I suspect that many lawyers are salivating at the arbitrary and capricious nature of this rulemaking. It was proposed with no meaningful public input or quantitative analysis or cost-benefit analysis. The Fed said it will begin collecting an onerous amount of data from banks after they release the NPR, and the agencies have indicated that the provisions in the rule may change over time as the agencies speak with the public sector. These are process failures, and they mean that the public does not have the data and final proposal to assess during the comment period to provide meaningful input on the proposal. Mr. Ullman, can you please touch on this, these many administrative law fouls? If the Fed was still molding the proposal and collecting data, shouldn't they have proposed an ANPR to allow industry experts to provide input?
Yeah, thank you for the question. And just to be clear, these aren't just technical process problems. These are statutory violations. The Administrative Procedures Act is federal law enacted by this institution to make sure that agencies, when they engage in rulemaking, have established a process that allows the public to engage and that requires agencies to act in an informed basis using the best available data so that an agency simply can't decide on its whim to take a particular action. It has to be reasoned and informed to help make sure there's good rulemaking in this country.
Thank you. And Mr. Brookschmidt, I want to talk about commercial real estate. You talked about residential real estate. Let me talk about commercial real estate. I'm very concerned. We've got $1.5 trillion of commercial real estate loans coming due. Many of them are set at 3.5%. They're going to have to refinance at 7.5%, 8% because of higher interest rates. $5.5 trillion of commercial real estate debt is out there. About 50% of this is held by commercial banks. These loans were financed when rates were around zero. Even with regulatory phase-ins, we know that financial markets will be affected immediately by the onslaught of new and onerous regulations. Is now the time to undermine the ability of banks to lend and to intermediate in commercial real estate markets?
Chairman Barr, we're very concerned about the same issue, and it goes back to the issue that we both discussed, or all three of us have discussed, about the lack of any underpinning, economic underpinning, not only to the rule itself, but how it interacts with other rules. You have another rule that is pending being made final for the Community Reinvestment Act that discourages banks from making multifamily loans for new apartments, for instance. And this will interact with that in a way that can really slow down our economy.
My time has expired, but I would hope that some of the political people at the White House would inform the Fed that they don't want a recession right before an election.